Good morning and welcome back to Market Mondays, our webinars where myself, Daniela, and my colleague Kyle take you through some of the key events to watch out for this week, both on the calendar and elsewhere. We are both senior market analysts. Kyle, good morning.
Good morning, great to see you.
Yeah, so as always, a little bit of housekeeping, just to take our viewers through the risk warning. I'm sure most of you are aware of this by now, but the products that we do offer at Capital.com are leverage products. They are high risk products, so both CFDs and for those of you in the UK, spread bets as well. They have a high degree of risk, and you should be aware of these risks when trading them with Capital.com. Kyle, over to you.
Yeah, just to say, obviously, that all the information here is of general nature only, doesn't take into consideration anybody's personal circumstances. That's obviously key for the Australian market there. And as you said, highly risky instruments, so you have to consider whether they are appropriate for you before trading. But otherwise, Danny, we may as well push on because, well, there was a lot happening last week, and there's going to be plenty happening this week as well.
Yep, just to remind everyone, while we're doing this webinar, do feel free to send us questions through the Q&A or the chat box here on the webinar. We'll be happy to answer them as we go along. Key themes for this week, we do have to look more on the macro side. The geopolitical concerns have eased. We'll see that in the markets. We've got that clear move towards risk assets last week, and we now reintroduce that tariff talk because we are pushing towards the end of the 90-day pause that will happen next week. So markets have started to refocus on these talks. We've seen some comments from Donald Trump in the last few days about these tariff talks, because we do have to say over the last 3 or 4 weeks, more or less, we actually haven't heard publicly, at least, many developments on the tariff front. So markets have kind of pushed it to the side and focused on everything else going on, but now they're back on the table. On the data front, not the busiest week on the calendar, but we do have some key releases. We'll have the Eurozone inflation data and the US jobs data, which will actually be released on Thursday this week because it is a holiday on the US on Friday. It's the 4th of July. And then we'll look at US equities because they rallied to new highs. So Kyle, anything that you want to start off with?
Yeah, well, I suppose let's go straight just to, I guess, the record highs on Wall Street. And effectively, there's that proverbial wall of worry that equity markets tend to climb. And, we've erased all of the pre-Liberation Day and post-Liberation Day losses, which were obviously generated by trade uncertainty. It's effectively to say, as you noted before, Danny, that there's a lot of good news priced into the market at the moment, and it's more or less assumed that these trade deals will get done and will get done in a way, obviously, is for this deadline on July 9th and will be at rates far below that of Liberation Day, somewhere in the low teens, it would seem. So it's not going to be the case where tariffs are removed entirely and that we're going to return to a world, say, pre-Trump 2.0, where, the average level of tariffs in the United States were in the low single digits, perhaps 2, 3, 4%. We're looking at perhaps a sort of a baseline tariff universally of around 10%, probably a little bit higher than that. But as long as that does materialize, the market seemed to be fairly comfortable with it and kind of, pricing in one of the, perhaps a better set of circumstances than or not quite the best case set of circumstances, but fairly close to it. I think the critical relationship is obviously between the US and China. We saw that on Friday with effectively, the deal temporarily, or negotiations temporarily, between Canada and the United States breaking down. Obviously, things have been, mended, and that does look like it might have been a bit of a negotiation tactic from the Trump administration to sort of flip the table and walk away to get, the Canadians to talk about this digital services tax. But the most critical thing was this kind of framework. Trump called it a deal. It's not a deal. It's a framework about, rare earths and technology transfer that boosted the market to record highs. And really, although that there's all these sorts of things that could potentially go awry, and once more, arguably the risk is a little bit asymmetrical, because if things do fall apart before that July 9th deadline, then we're likely to see something of a pullback, especially if that's coupled with an immediate increase in the tariff rate. But when you do see equities hit record highs, you have to respect that signal that things are rather bullish, that the uptrend is still intact, and that really we're still in a situation that if we get positive trade headlines, markets are buying into that news, and we'll probably see the uptrend continue.
Yeah, agree. We are starting to see a little bit of overbought conditions, as you can see here on the RSI. This is the S&P 500 breaking to a new all-time high last week. You can see the very, very strong bullish signal here starting on Monday once the geopolitical tension started to ease. This was actually before the ceasefire deal was announced by Donald Trump on Tuesday, but markets already regaining that positive sentiment. We can see a little bit of a hiccup here on Wednesday, but a very strong bullish signal last week. Again, focus on trade talks, as we mentioned, and as you were saying, China, a big one, but also something to watch out for the European Union, the EU. We've heard Trump talk about this a few times, and even this weekend, he was reiterating that the EU has been very complicated and very tough to negotiate with. So again, unlikely that we see a breakdown in negotiations. I don't think it's in anyone's best interest. And at this point, I think we've seen that concessions can be made on both sides. So I think, of course, again, a negotiation tactic from Trump to kind of force the hand a little bit of the European Union. But nonetheless, there is that risk, as you were saying, that these trade talks could break down at some point. And if that were the case, we would see that asymmetrical side pushing equities lower. Interestingly enough, we've actually seen European equities struggle to regain a strong momentum like the US. You can see both the S&P 500, the NASDAQ finding that very strong momentum, both of them breaking to all-time highs. But if we're looking at the DAX 40, we're looking at the Stock 600, or we're looking at the FTSE 100 down here, you can see we've actually struggled to regain that bullish momentum, even as that positive sentiment was filtering through the markets last week with that peace deal talks in the Middle East, and that supposition that nothing was going to escalate further. We do still have, of course, the peace talks in play. They do seem pretty fragile. So again, we could see some news from the region, but nonetheless, it seems like markets are kind of done with being concerned with that for now and focusing on the possibility of those trade talks. We are seeing some strong momentum. We saw some strong momentum on Friday there to end the week for the Stock 600, but again, struggling to find that momentum. So we could see a little bit of this actually coming from the fact that markets may be concerned that even though Trump's positioning towards these trade talks has improved, and it looks positive that we are going to get some good developments, the trade with talks with the EU could actually pose a little bit more risk to the market and therefore for European companies. So seeing a little bit of a lag here in European equities, but nonetheless, again, the momentum building once again to the upside. The RSI struggling to push through that midline just yet. So looking for a little bit of confirmation from the RSI but it does look, as you were saying, like the momentum and the path of least resistance looks to be to the upside this week in the absence of any negative catalyst. Now, one more thing to point before we move on is we did actually see some data from the Fed on Friday, the stress tests from the Federal Reserve, kind of signaling that if a recession were to happen in 2025, all of the major banks in the US, I believe the 22 of them, passed successfully and would be able to withstand a recession in this year. So again, that is a positive signal to the market, once again reigniting that bullish sentiment and reigniting that positivity in markets. So as we were saying, the key drivers this week looking to reinforce that positive momentum in equities. Carl, what about the data front? As I said, we do have the Eurozone CPI data, which we'll cover in just a second. But I guess pulling into this, we have the US jobs data on Thursday. We've seen some very strong resilience in the labor market. We have seen a little bit of a signal of weakening in recent months, but nonetheless, still nothing to prompt the Federal Reserve to cut rates, nothing to prompt markets into believing that the US economy is struggling. Do you think this data is going to be impactful at all?
I think it will be. And just before we run on to that, I just want to make a quick note. Maybe if you even, or we don't have it there in front of us, just to talk about the rally on Wall Street and the fact that it once again has been driven by more or less a narrow set of tech stocks, Magnificent Seven perhaps loosely, but certainly that the sort of Magnificent Six ex Tesla. Although Tesla has performed well over the last few weeks, it has to be said, since the sort of announcement of the robo-taxi and all those sorts of things. Just to note that a really good sort of divergence that's occurring is that we've got the Nasdaq and the S&P 500 at record highs, but the Dow's not at record highs just yet, which sort of suggests that a lot of this rally on Wall Street once driven by, which is, really kicking a week's time. These companies not making record highs just yet, which sort of reflects that there is going to be kind of a growth hit from these tariffs, and we're experiencing some of that growth hit both in the United States and abroad. So, one to keep an eye on, because if we do get some fairly significant trade deals, maybe something slightly better than expected, a little bit sweeter than expected, then the cyclical area of the market is likely to perform a little bit more strongly. Just to note on that, the data, as you sort of pointed us towards, Danny, a really interesting dynamic at the moment, because effectively what we've got is the market's pricing in a higher chance of a July rate cut. It's around sort of probably a little in the high teens. It got up to about 25% implied probability at last week before that inflation data. But we've more or less got the market still pricing in 2 rate cuts before the end of the year, and certainly flirting with the idea that there could be a cut in July that was sort of supported by some of the rhetoric that we got from Fed officials and Powell last week at his testimony. Although the overall testimony before Congress, although the overall sentiment was wait and see. And there was a really interesting reaction to the inflation data that we got on Friday night, which was, more or less the markets continuing to hit record highs, the US dollar shrugging that off. There was a little bit of a move in rates markets, but largely speaking, there wasn't that great a move to a core inflation figure, or core PCE figure, which came in higher than expected and was about 2 points higher than the month prior at sort of 2.7% or so. And I think there's 2 things that can describe this dynamic. First, effectively, the Fed, we have to remember, in its dot plots, projected that it expects inflation to rise to around 3.3%. I think it's on the headline basis, 3.1% on a core basis before the end of the year. So more or less, they've given themselves this extraordinary wiggle room with upside surprises to inflation that the markets aren't going to overreact to. And that's also in the context that the Fed is still projecting or still implied in its dot plots 2 cuts before the end of the year, despite this lift in inflation, which is to say that it's going to look through any kind of price shock potentially, as long as it's fairly moderate, and continue to lower interest rates. And the markets, I think, are really buying into that. The next part of that is that we're starting to see some signs of weakness in the labor market through jobless claims, but specifically this week, that the non-farm payrolls figure is going to show increase in employment in the low 100,000s, not too bad, but an unemployment rate that ticks up to 4.3%. And so I think effectively what we've got is the market's placing a little bit of a bet that the Fed isn't going to overreact and maybe even look through some of this inflation data, but will continue to remain cognizant of what's happening in the labor market and perhaps adjust rates to be able to support it progressively, assuming that the weakness that we have seen prevailing over the last couple of months in the US economy, not extreme weakness, but certainly some degree of weakness, certainly not the strength that we saw at the start of the year, where, we had the US exceptionalism trade in play and everything was running very, very strong. That, we are going to get a higher unemployment rate and a Fed that's going to adjust policy perhaps in response to that. So that remains really interesting, because the signal for me is that effectively good news is still going to be good news, bad news will be bad news for the labor market. If we see a stronger than expected number, I think that's going to be positive for market sentiment, because the markets are focused on the labor market. And more or less as well, if we do see this kind of downside surprise, the odds of a rate cut from the Fed is going to be brought forward even further. Again, on the very strong assumption that effectively the Fed is going to be focusing on its employment mandate rather than quite as strictly its inflation mandate, which everyone seems to be looking through.
Yeah, another key data point this week is going to be the Eurozone CPI data, which will be released on Tuesday morning, so tomorrow morning here in Europe. Now, interesting reading again. This is, of course, the preliminary reading for June. We know they always release it pretty early pretty early in the new month. And we are expecting to see the CPI data strengthen slightly, or that's what markets are pricing in, from 1.9% on the headline last month to 2%, core remaining unchanged at 2.3%. But what's going to be interesting for me are those monthly readings, because last month in May, we actually saw 0% growth both on headline and core on the month-on-month reading. So essentially signaling that no inflation growth had been seen in either of those readings, which is pretty significant. And of course, it takes a while for that to factor into the 12-month figure, the 12-month average. But nonetheless, that inflation, that monthly inflation coming in unchanged, signaling that the price pressures have been cooling in the Eurozone. We'll have key regional inflation readings before that. We'll have Germany being a key one, which will be released later today. So we'll be interested to see how the German inflation data prices into that as well. We may see markets price accordingly or adjust their pricing after the release today. We're expecting to see actually the month-on-month reading in Germany come in a little bit stronger than last month, from 0.2 to 0.3 on the headline there. So potentially seeing markets react to that slightly today as we look towards the overall data tomorrow. But again, quite significant if we were to see again that monthly reading come unchanged. That would signal, as I said, that price pressures are easing. Now, in terms of the European central banks, I don't see how much impact this could have if the data comes in as expected. We can look at the euro dollar chart here. As you can see, we've been seen some strong momentum from the pair that last week, but that of course coming a lot of it from the weakness in the US dollar, as you can see, as it reignited that bearish trend. When you're looking at other currencies, for example, euro sterling, you can see we're struggling to find direction here, seeing a little bit of downside pressure on the euro. Again, when it comes to the ECB, if the data comes in as expected and we see again another reading that shows subdued growth in prices in the region, I'm not sure how much impact that will have to pricing what's going to happen at the next meeting. We have to think that the ECB has been one of the most dovish banks over the last year and a half, cutting up to 250 basis points already. So it sits now in a very comfortable position where it's able to monitor the latest data without having to react necessarily in a kind of instant reaction kind of way. Like, for example, what's expected could happen from the Bank of England if the data does worsen significantly. So the European Central Bank has given itself a lot of wiggle room to be able to adapt to what could happen. And I think that's led markets to price in no change for the next meeting. Current pricing showing 88% chance of no change at the July 24th meeting. So again, how much this can change with the data, I'm a little bit skeptical. As I said, even if we were to see a weaker read, and even if we were to see potentially, I don't know, let's say monthly CPI coming in negative, or even the headline and core year-on-year readings showing no change, or even coming in a little bit below forecast, I struggle to see markets really thinking that that's going to push the ECB into cutting rates once again, when there is so much in terms of price pressures, external shocks that could still happen when it comes from unresolved tariff talks, also geopolitical tensions. Even though they have eased, we could still see a shock to energy prices if that evolves further. So I think the ECB is in a very comfortable position. I think they've set up their monetary policy in a way that allows them to be complacent for a few meetings, to just stop and pause and observe what's going on. So again, I don't think this data, if it were to skew from what's expected, it would induce higher chances of a rate cut at the next meeting. On the flip side, if we'd see a little bit of a stronger reading, again, I don't think that would by any chance induce expectations of a hike, but it will likely reinforce the belief that the ECB is unlikely to cut rates at the next meeting. So again, something important to watch out for from the European side is that expected CPI data out tomorrow.
Yeah, definitely. And we've got that euro obviously so close to the 118 handle already. And there's that kind of structural story playing out as well, where, de-dollarization persists more or less because of this kind of loss of faith in US assets and the cyclical side too of a US economy that's converging with the rest of the world. So it'd be fascinating whether we do see that kind of continued push higher, especially if the inflation data is a little bit more persistent. I was going to say resilient, that's not the right word, but a little stickier, perhaps a little higher than expected, especially because we are getting that kind of oversold reading on the RSI too. I think we just got a question. We'd like to talk about gold and oil at different stages. So we may as well shift on to that, because there is that kind of noteworthy loss of momentum in the gold price. Despite, headwinds really still being there, the geopolitical tensions have eased, but the markets we're pretty unresponsive to it relative to other flare-ups in the Middle East, and we've seen that kind of pullback continue. That's happening as well, despite that kind of weaker US dollar, and also the market's kind of pricing in the higher odds of a July rate cut. So it's a fascinating dynamic at the moment. I'm still kind of bullish, but you have to respect the price action, maybe a little bit more of a sell-off to sort of play out here, especially given you can kind of see that there's been a fairly clear rejection of technical resistance around 3,400 to around 3,500, that sort of resistance zone. Perhaps a sign that that the price of gold up there, at least in the short term, is a little bit too rich for the markets, and maybe due perhaps somewhat of a deeper pullback. That kind of low 3,200 handle where there seems to be a bit of support and resistance. Something to keep an eye out for, because again, both in the short term and the long term, there seems to be a lot of tailwinds for gold, notwithstanding maybe some solid market sentiment in equities, but that really hasn't been much of a driver anyway of gold prices. It's those longer term and shorter term stories. But yeah, nevertheless, it looks like momentum is really sort of slowing to the downside. And I note too, just looking at the charts now that we've sort of emphasizing it and enlarged it, that the RSI is below that sort of 50 level on the daily RSI. Again, just a signal that maybe the markets are kind of becoming a little bit exhausted with prices up at these levels.
Yeah, agree. I think even last week, if you were a long-term buyer of gold or you were holding bullish positions, you would question whether coming out of them, because as we were saying, fundamentally, there's still so much support. And even though we had seen that bearish momentum start, there was still some hope towards the end of the week that maybe that reversal wasn't going to go any further and that buyers would re-enter the market. I think now, again, we start to question whether that's, as you said, not the case, and we're still in for a little bit more of a short-term pullback. You can see we've also dipped below that 50 day moving average, which is that black line here. Again, it's been a very significant area of support since the beginning of this year. So going on 6 months now, we've seen it kind of contain the downside here. Even though we did manage to break below it on a few instances, we never managed to close below it. And we also gold always found support around this level. So again, we have actually broken below it for now 2 sessions. So again, bringing back into play the fact that maybe there is some further short-term downside here. As you were saying, also the RSI now dipping below 50. So it could be that we are looking to pull back towards this 3,200 area, which has offered some support in the past. But even lower, as I said, for me, as long as we remain above that 3,000 level, then I think that the strong long-term fundamentals, tailwinds that you've just been mentioning, that we've mentioned in so many webinars, I think they still remain supporting gold prices. I think that 3,000 level would start to bring in some skepticism towards that thought, and maybe then we would start to see a little bit more of a change in that dynamic. But for now, as we said, look, it looks like we are going to face further downside pressure here in the short term. So it's just a case, I think, playing the market, seeing where it goes, and also just finding where buyers feel comfortable to come back into the market, even as everything else it seems to be pointing towards risk appetite in equities and also in the data as well. So interesting there, as you were saying, momentum for gold with everything that's been going on. This leads us, of course, into oil. Very interesting week last week. Of course, this candlestick being very dramatic, which is that pullback that we saw on Monday. We did see that initial jump at the open as the news came through over the weekend, last weekend, of course, that the US had attacked 3 nuclear sites in Iran. We quickly undid that as markets started to price in the fact that they weren't expecting any further escalation in tensions, and that negative push continued, as you can see here, to the downside, coming to rest below $65 per barrel on US crude, which has been, again, a key area of resistance in the past. And throughout most of the last 2 or 3 months, we've actually held below this level. So it looks like markets have been happy to undo this rise in prices on the back of that escalation in tensions. And interestingly enough, from the supply side, as we said, markets clearly now not expecting a price shock from limited supply from these tensions, but we've actually seen OPEC open to potentially increasing their production in the next month on the back of potential disruption in supply. Whether that's going to happen or not remains to be seen. But again, the supply side really not an issue here in oil prices anymore, and that's clearly what's been leading this move lower. I guess now the question is, where do we go from here? Do we start to see a little bit more interest in buying just in case things escalate again, or do we see the natural progression of this price kind of hover around these levels with a little bit of a downside bias?
Yeah, I think I've kind of been using sort of four parameters to assess whether oil prices might move higher once again in response to these sort of geopolitical tensions. And it's more or less, whether the war broadens out between between Iran and Israel and becomes a little bit more of a regional conflict. Second to that, does the US intervention become more than just airstrikes and becomes, almost boots on the ground? Does there become a serious shift, I should say, push for regime change in Iran? And then finally, does that all culminate in a blockade of the Strait of Hormuz, which the reason why the markets clearly thought that the airstrikes on US bases in Qatar were a sort of a selling opportunity for oil was that was sort of a signal that a sort of de-escalatory response that wouldn't involve a serious risk to energy supply and blockades of the strait there. There was also the rationale that the Iranians aren't going to want to sort of use the, pardon the pun, nuclear option when it comes to their leverage with the rest of the world, really on the basis that China is their biggest customer. It requires Iranian oil to be able to obviously or cheap Iranian oil to be able to sort of fund its massive industrial machine, and that Iran more or less needs the income generated from oil to be able to continue to fund itself. And quite naturally, it's a sort of a moribund economy that needs all the income that it can kind of muster. So there is that sense the markets are thinking, okay, well, those variables or those parameters aren't going to be violated, and that we've also got OPEC coming in now suggesting that it'll increase output, like you said, Danny. But I think it's around 411,000. I think the specific number is barrels per day. And if that is the case, then we might see more or less a return to the trading range that prevailed in the market prior to these kind of major geopolitical tensions and the Liberation Day tariffs prior to that, which was effectively to say somewhere between the mid 65s and the mid 75s or thereabouts, and a sort of a much more well-contained, price range, which sort of traders can obviously utilize to try and set their positions, but will otherwise be sort of a trendless kind of a market. It'll be very much range bound. It will be fascinating to see in the short term whether we go through that $64 level, because if we do that, then I think that we could sort of see a push back to that sort of cluster of support in the low 60s. Alternatively, there does seem to be a bit of a short-term level at around that kind of 65, 66, which might be sort of worth noting as to whether we get a bigger bounce. But overall, the volatility in oil seems to be reasonably contained. And again, it's those kind of four key variables when it comes to just these geopolitical risks that I think if we don't see any of those kind of met, then again, I think we're back to a far more settled oil market, despite the fact that this ceasefire between Iran and Israel does seem a little bit tenuous. It has to be said.
Well, I think that's most of what we need to cover this week. Just got a question come through about sharing the full episode. You are able to find these are recorded and they are posted on our YouTube channel in the next hour or two. So if you do look through Capital.com YouTube channel, you will be able to find all of the recordings of the webinars that we do there, and you're able to watch them on demand. So that is there for you. As always, thank you everyone for joining so much. Thank you for your questions. Kyle, thank you for, of course, joining and having a very interactive discussion. And I guess we'll see everyone on Monday next week.
Sounds fantastic. Have a good week, everybody.